Welcome back to the SIE podcast, the Securities Industries Essentials Exam podcast. This is going to be the third sample lesson of the 5 free sample lessons I'm going to share with you in this podcast. Also, there will be other material in this podcast later on. This is going to be the third lesson of the audio course. The full audio course is 36 hours and 53 minutes in total length and consists of 69 audio files. In this lesson, we're going to be talking about preferred stock, and you're going to find out preferred stock is a lot different than common stock. So let's get on to that lesson right now. Welcome to the Securities Industry Essentials Examination podcast, audio lessons for the SIE exam. This is lesson number 3. It's going to be covering preferred stocks, and in the outline, it's going to be covering section 2.1.1. In the last episode, we talked about common stock, and I pointed out that in the event of a dissolution of a company, the common stockholders stand last in line to receive any assets or cash from the dissolution of a company, and that would be the bankruptcy or the liquidation of a company. All the other creditors stand in front of the common stockholder. The common stockholder is the last in line. In this episode, we're going to be talking about preferred stock. And preferred stock is a little different than common stock because preferred stock has a par value that actually means something. So preferred stock is, just think of the name, preferred has a preference over common stock. Now, there's a lot of different types of preferred stocks out there. There's cumulative preferred, there's non-cumulative preferred, there's convertible preferred, and a few others, but we're not going to get into, we're not going to get into any more than pretty much that. So when a preferred stock is issued, it's issued with a par value, and the par value is the value of that stock in the event of a dissolution before the stockholders or before the common stockholders get anything. So a preferred stockholder would get back 100% of his par value on that stock before the common stockholder would get anything. Now, he may not get back 100%. He may get back whatever is left over after the creditors, which are senior to the preferred stockholder, get first. So it all depends on your hierarchy in the liquidation or dissolution of a company. So we're going to go over some terms, and we're going to basically just define some terms and talk about what those terms mean. Well, when a preferred stock is issued, it's considered a senior security over common. Debt is senior over preferred stock. So the preferred stockholder stands above the common stockholder, but the debt holder stands above the preferred stockholder. So when a preferred stock is issued, it's typically issued at, let's say, $100 par value. And if you look at a preferred stock sheet, it may say preferred stock $100, 10%. And that 10% is the dividend that is paid on a preferred stock. So let's say a stock had a par value of $100 and at a percentage interest rate or an interest rate of 10%, the holder of that preferred stock would expect to receive $10 per year. That's the dividend rate on the preferred stock. Most dividends on preferred stocks are paid on a semi-annual basis. And remember, in common stocks, most dividends are paid on a quarterly basis. However, that's not a hard and fast rule. Some preferred stocks only pay dividends annually. You need to look at the information for the specific preferred stock to determine how often it pays dividends. Also, some preferred stocks pay dividends on a quarterly basis. So there's no hard and fast rule for when dividends are paid on preferred stocks. You will commonly see preferred stocks issued with a par value of $100. I've also seen a lot with par value of $50, and there's some out there with a par value of $25. So the par value was really determined by the issuer when they issued the preferred stock. Preferred stock differs from common stock in the fact that it pays a fixed dividend. The dividend will not rise with the prospects or earnings of the company. It's a fixed dividend. So a 10% preferred stock will pay a 10% dividend. It will never pay a 12 or 13% dividend on the par value. Now, buying a preferred stock on the secondary market, but what I mean by the secondary market is just the market after the stock has been issued. When you initially issue a stock, when a company initially issues a stock, that's called the initial issue of a stock. After that, the stock trades on its own, and whether it's preferred stock or common stock, it's the same thing. The market will determine the value of the stock. So let's take a real simple case. Let's say the company issued $100 preferred stock at 10% interest, and the prospects of the company decline significantly, and the secondary market on that stock, let's say, would drop to $50. Well, you're still getting a 10% dividend on the par value. But if you came in and bought that stock at $50, your effective dividend rate, as long as a company continues to pay the dividend, would be 20%, which would be the same $10 divided by $50, your cost. But when you look at preferred stocks, it will always state the dividend based on the par value, not on the secondary market trading value of the stock. Now, just because a preferred stock has a stated dividend, it does not mean that you will always receive that dividend. The board of directors can choose not to pay the dividend on a preferred stock. That's up to the discretion of the board of directors. And if a company is in financial stress, it may choose not to pay the dividends. Now, if a company that has preferred stock outstanding chooses not to pay the dividend, it really depends on how the preferred stock was issued to begin with. If the preferred stock has what are called cumulative rights, it means that before the company can continue paying the common stockholder dividends, it must pay back all the cumulative dividends that were due the preferred stock before the common stockholders will be able to start receiving dividends again. If it's a non-cumulative stock, that is not the case. But the preferred stockholder must be paid his dividend before common stockholders are paid their dividend. Now, who would be the buyers of preferred stock? Well, quite often it's corporate treasurers. Corporations with excess cash will often buy preferred stock because the dividend is relatively secure. It's not 100% secure, but also because there is what is considered a dividend exclusion. And this dividend exclusion, as the code stands right now, means that corporations can exclude 70% of income derived from dividends from their taxes. So they only have to pay tax on 30% of the dividends. So that's a big incentive to buy preferred stock versus interest-bearing debt, because interest-bearing debt does not have the same exclusion. Now, this dividend exclusion rate changes from time to time. In 2003, it was 80%. Today, as it stands, the dividend exclusion rate is 70%. But that can change. This dividend exclusion does not apply to individuals. Individuals' tax rates vary, and the treatment of dividend income with individuals changes from time to time. Now, there's two types of dividends that corporations pay. Some dividends are non-qualified dividends. And a non-qualified dividend is usually a dividend from the management of fixed income investments. For instance, money market funds, even though you receive those dividends, they are not considered qualified dividends, so there's no special treatment on the dividends from fixed income type companies that distribute the income to the stockholder. And these would be mutual funds that manage fixed income investments, money market funds, and so forth. Sometimes you will get a dividend and part of it will be considered a qualified dividend and part of it will not be considered a qualified dividend. This is always disclosed in the 1099s that individuals receive from corporations at the end of the year. But the big advantage to corporations that buy preferred stock is that they get a 70% dividend exclusion. So they only pay taxes on 30% of the income from a preferred stock or from a common stock for that matter. But corporations look for security before capital appreciation. So corporations, when they're using corporate cash and they just need a place to park it, they will commonly preferred stock for some of that. They will also use other investments such as commercial paper and short-term government bills. Now, what influences the price of preferred stock in the secondary market? Primarily, it's going to be interest rate movements. And we're going to get into the whole section of interest rates and interest rate movements in later episodes. But just suffice it to say that if interest rates go up, the secondary market on preferred stocks will go down. Sometimes preferred stocks will be affected by the company's prospects, especially if there's a lot of bad financial news on the company. There may be a fear that dividends will be cut or not paid, and that would drive the price of a preferred stock on the secondary market down. Now, the opposite is not true. If the company's prospects improve, the dividend rate on a preferred stock very seldom rises above the par value. The secondary value of a preferred stock does not usually rise much above par value, and we'll talk about that now. When preferred stocks are issued, they are usually issued with a call date, not a date that they will buy back the preferred stocks, because all preferred stocks are issued as perpetual preferreds as a general rule. That means they don't have to be called at any time to be bought back. But companies will put a call date in there when they may choose to buy back the preferred stock. So this tends to put a cap on how much a preferred stock will go up in value, because the company could always buy back the preferred stock at par after the call date has been passed. Usually when a company issues a preferred stock, it usually has a 5-year period when it cannot call back the preferred stock. And the call dates vary by the company that issues the preferred stock. But as a general rule, 5 years is a good number to think about on a new issue of a preferred stock. After that 5 years has expired, the company has an option, but not the obligation, to buy back that preferred stock at par. There are some formulas that affect preferred stock in a general rule, and these are formulas that relate primarily to interest rate movements. There's a few yields that you need to understand when you're buying both common stock and preferred stock. And there's the stated yield on a preferred stock, which is the yield on the par value. But very seldom do you end up in the secondary market buying a preferred stock at par value. It could be at a slight premium to par, and it could be at a discount to par. How you calculate your dividend, and this is called the current yield, is the dividend in dollar amount that you can receive from that stock, that common or preferred stock. The formula is the same, divided by the price that you paid for that stock. Or if you don't own the stock and you're just looking at it, divided by the market cost of the stock, the market price of the stock. So for instance, if you bought a preferred stock that paid a 10% dividend and you paid, let's say, $90 for that preferred stock, your yield would be $10 divided by $90, which works out to be, and let me grab my calculator here, 11.1%. There's another concept, there's another formula that you can start looking at, and you may be tested on, and that is the theoretical market price that a preferred stock should be trading at. And that formula is simply the annual income divided by the current market yield on equivalent stocks, and that should equal out the current theoretical market price. So let's say you had a dividend that paid, or a preferred stock that paid a 13% dividend. It was 100% par value. So you'd get $13 per year as a dividend for that stock. And let's say the market yield is 10%. So you would divide the 13% by the 10%, and you would arrive at a theoretical value on that stock of $130. Now remember what I said earlier. The chances of preferred stocks rising significantly above par value is going to be affected by the call dates and the likelihood of being called on that stock. If you paid $130 for a $100 par stock, after the call date is expired, you run the risk of you losing that $30 premium. You may end up getting only $100 for that stock. So that tends to put a cap on the appreciation of preferred stock. Now, the theoretical interest rates go up, then the theoretical market value of a preferred stock should go down. So let's discuss this for a minute. When the company issues a preferred stock, it must issue the preferred stock at very close to the market rate of interest rates at the time. But let's just say, for simplicity's sake, a company issues a $100 par value preferred stock with a 10% yield. Remember, that 10% yield is going to stay constant, assuming it stays constant. Let's say interest rates move to keep it simple, 20%. Well, you're still receiving that same $10 per year. But now that $10 should reflect a 20% market price. So the value of that preferred stock on the secondary market should drop by about 50%. So that $100 par value stock would be trading in the secondary market at near $50. This is a concept that's sometimes fairly difficult for a lot of people to grasp, but it's a key concept that you must understand, not just for preferred stocks, but also when we get into fixed income investments. Preferred stocks have no voting rights. They do not get to vote on the corporate directors. Sometimes people think a preferred stock is similar to a bond, but there are some key differences between a bond and a preferred stock. And the biggest key difference is that preferred stocks are perpetual stocks. They do not have a maturity date, and they do not have a guarantee of dividends. The dividends on preferred stocks can be stopped by the board of directors. Bonds stand in line in front of preferred stockholders in a dissolution of a company. So they have priority over preferred stockholders, and preferred stockholders have priority over common stockholders. Bondholders have a legal right to an interest rate. Preferred stockholders do not have a legal right to a dividend. Bondholders who receive interest payments are taxed at the maximum rate, while there are some tax preferences for preferred and common dividends for corporations. Now here's a term we talked about earlier, cumulative. Cumulative just simply means that if an issuer omits a dividend on any dividend payment date, that dividend must be made up before common stockholders are paid a dividend. They must cumulatively pay back the dividends that were missed before common stockholders are paid any dividends. Another term you need to understand, and we've talked about this, is call. A preferred stock is callable, and there's a specific date, usually 5 years after the initial issue of a preferred stock, that it becomes callable. There's other types of preferred stocks, and these are called convertible preferred stocks, where you can convert your preferred stock into the common stock of the corporation. And there's usually a conversion ratio or a conversion price. When they issue a convertible stock, they will state at which price it is convertible into common stock. So for instance, if it's a $25 conversion price and the common stock is trading at $15, there would be no reason to convert into the common stock unless the common stock rises above $25 a share. And when a common stock rises to its conversion price, that's called parity. That's when there's no incentive to or incentive not to. That's the parity price of the conversion. Now, sometimes you will see the common stock rise above the conversion price. And at this point in time, sometimes companies will call the preferred stock. And this, in essence, forces a conversion into the common stock. And the reason for this is the value of the preferred stock will be called at par, yet if you convert into the common stock, you could sell the common stock at a price above par. And this is a technique that corporate treasurers may use to try to improve the company's balance sheet. There's another type of preferred stock, and this is called participating preferred stock. And this is a preferred stock where the shareholders are able to receive higher dividends if the company's performance is better than anticipated. And all this is spelled out in the issuing documents for the preferred stock. There's another type of preferred stock called an adjustable rate preferred stock. And these preferred stocks, dividends change to try to maintain the secondary market value at or near par. And these dividend rates may change as often as daily, sometimes weekly, sometimes monthly. Another preferred stock that is very similar to an adjustable rate preferred stock is called a variable rate security. And this is designed so that the interest rate changes just like an adjustable rate preferred stock. That's going to close up this session. So let's just go over the terms you need to make sure you understand. What's the difference between a common stock and a preferred stock? How do interest rate movements affect the value of a preferred stock? What is the current yield? What is the par value of a preferred stock? What is the interest rate of a preferred stock? If interest rates rise, what would you expect the secondary market on the preferred stock to do? Do preferred stocks have voting rights? Where do they stand in a dissolution of a company? What is a cumulative preferred stock? What is the call feature of a preferred stock? What's a convertible preferred stock? What is the conversion ratio? How would a company force the conversion of a convertible preferred stock? What is the parity price? What's a participating preferred stock? What's an adjustable rate preferred stock and a variable rate preferred stock? Thank you for listening to the third sample lesson of the full series of audio lessons for the Securities Industries Essentials Exam podcast, audio lessons for the SIE exam. I hope you found it educational and somewhat entertaining. If you want to buy the full series of audio lessons, the full 36-hour and 53-minute series of audio lessons, go to siepodcast.com or my other sister site, series7podcast.com. Best of luck in your studies.